Hi traders, I go by the name of my G, and welcome to Veritas Trading Academy. And in today's lesson, we will be discussing the three market forces. Okay, the information in these lessons should unlock certain locks on you as a trader to understand the market dynamics a little bit better. Furthermore, this will help with understanding. You can't understand the actual trend just using price action alone, or volume alone, or COT data alone, or even indicators alone. That would be like using a butcher knife for every little thing that you have to do in the kitchen. Now, moving right along, let's dive in. So let's check what's on the menu today. The first thing that we're going to look at is introduction to market forces, where we'll be introducing you to the market forces. The second thing is we'll be talking about liquidity and volume. The third thing will be a quick discussion on price action. The fourth thing will be sentiment analysis or market sentiment analysis, which goes hand in hand with the COT report data, the commitment of traders report data. And then lastly, we'll be looking at integrating all these market forces all together to see how you can actually use all of them at once to actually improve your trading strategy. Now let's begin the lesson. Let me introduce you guys to the three market forces that we've shared and taught with our traders. Now I'm going to be sharing this with you with the hope that you will start to understand supply, demand, and economic impact a little bit better. Now, we at Veritas define these market forces as critical elements that influence the behavior of financial markets. Now, what you'll realize is that using these market forces, it helps traders to predict market trends, manage risk effectively, and lastly, it enhances their trading edges or strategies if applied correctly with understanding. The market forces we are talking about are volume or liquidity, price action, and market sentiment. They are all interconnected, and if you can understand their relation, this will not only help you, but it will enhance your trading strategy or your edge development and market analysis. Now, understanding how they work will give you the ability to analyze volume, price movements, and market sentiment. You will improve your market analysis capabilities, and your knowledge on the COT report interpretation will solidify a bit more. Now, let's talk volume. What is volume? How do you use it as traders? These are the questions that you should be asking yourself as a trader. And taking into consideration that volume is one of the key factors influencing market dynamics. But first, let's start with liquidity before we can move to volume. Now the question is, what's liquidity? Or what are the types of liquidity? And is liquidity important? If so, why is it so important? So let's dive in. In a formal setting, liquidity refers to the simplicity with which an asset can be bought or sold in the market without affecting its price. High liquidity indicates a healthy market with available buyers and sellers. And remember that for every buyer, there must be a seller willing to sell to the buyer, and vice versa. For every seller, there must be a buyer willing to buy from the seller. This is the only time I want to be in the market, and I would suggest that you guys do the same. Now let's talk about low liquidity, which indicates a little bit of difficulty getting rid of your positions, liquidating your own position in the market. So preferably, don't take trades during this time. I'm talking about when there's low liquidity. Now, we can move on to the types of liquidities. Now we have two types of liquidities. We've got what we call market liquidity. This refers to the ability to quickly execute trades in an active market. Then we're going to move on to the second one, which is funded liquidity, which relates to the availability of cash to facilitate transactions. Remember, every trade is a transaction between a buyer and a seller. Now we can move on to what? The importance of liquidity. Preferably, if you are to trade around times when there's high liquidity, because what will happen is you'll get much more efficient price. You'll enjoy it in reduction in unnecessary volatility or even noise. You will get better execution on your trades as well, or on your orders as a trader. Now we can move on to volume, of which here we'll be talking about volume analysis. The question is, what is volume? What types of indicators can you use for volume purposes? And the other thing is, what's the relationship between volume and price? Well, we're going to answer that. So at Veritas, we define volume as the number of shares or contracts traded within a specific time frame. It serves as an indicator of market activity. So basically what you can do with volume, you can actually measure the strength of a trend. It helps you and I as traders to confirm price trends or potential reversals. What I would urge you to do is read a book by a lady called Anna Cooley on volume price analysis. Some call the method volume spread analysis. It was an eye-opener for me when I read it. Yeah, that's about when, a decade ago, I think. Yeah, a decade. It's a really good book. So there's a few things that I consider when it comes to volume. Now, there's the first one that we'll be talking about is volume validating price. And the second one is volume and price anomalies. So what do we mean by this? Picture this. If volume is rising and price is rising, that's an uptrend. It's a strong uptrend. If volume is rising and price is dropping, that's a downtrend. A strong downtrend. This is what is called volume validating price. So volume and price are talking the same language. Now, when volume decreases and price rises, this indicates a weakness in trend to the upside. Secondly, if volume decreases and prices drops, that's an indication of trend weaknesses to the downside. This is what's called anomaly in volume price analysis. That's where price and volume are in contradiction. So they're not talking the same thing. You can use volume indicators like OBV, which stands for on balance volume, or use volume moving averages to assess the strength of price movement. Remember this, that high trading volume indicates stronger trends, while low volumes may signal consolidation, or potential reversals. As a trader, you need to understand these relationships. But further studying, you have to consider these four events below. Okay? So, there's something called accumulation, which is consolidation before an uptrend in simple terms. There's something called distribution, which is consolidation before a downtrend. Both these consolidations happen to induce the retail side to buy before a downtrend and to sell heavily before an uptrend. You can simply identify them by looking at what volume does around your support or resistance line. So let's talk about accumulation. So during accumulation, what will happen is volume will shrink near your support line and expand near the resistance line. And during distribution, volume will shrink near your resistance line and expand near the support line. The other thing that you need to look out for are these two terms called selling climax and buy climax. So selling climax, that's a downtrend after distribution. Buying climax is an uptrend after accumulation. Now let's talk price action. What's price action? What it entails? Does it work in the markets? So if you're to realize, or if you had to check around the trading space, you will realize that price action traders use market movement through price trends to mold their trading edge or strategy. Now, what is price action? At Veritas, we say price action is a movement of an asset price over time, serving as a key indicator of market behavior. There's a couple of key concepts that you must look at, such as the first one is trends. So in price action trading, what a lot of price action traders do, they will first identify the trend. How do you identify the trend? In case of an uptrend, the market will be making higher highs. In case of a downtrend, the market will be making lower lows. The second thing to look at is support and resistance. Remember what we said about volume. What happens at your support level and your resistance level, whether you're in accumulation or distribution. The third thing is candlestick patterns, which can be your engulfing patterns, your dojis. Those are often used for entries. And then the last thing is chart formations. Those are your flags, your triangles, your head and shoulders. Those are some of the candlestick, the chart formations that we're talking about. Okay. Now, what you need to realize about price action analysis, it focuses on historical price movements to identify patterns or trends. Like we said before, in a downtrend, the market makes lower lows. In an uptrend, the market tends to make higher highs. So including these key patterns, is actually very, very important for your entries. But you can use patterns such as your head and shoulders, your double tops. Some price action traders even use trend lines, which help the traders to anticipate future price behavior. And the trends dictate overall market direction. Now you can analyze price movement by looking at candlestick patterns, support and resistance levels, time frames, and their impact. What price action traders use in most cases, is key formations such as a doji, engulfing, hammers, and many more. In the case of support and resistance levels, at the support level, most traders will be looking at taking buy trades, meaning that there's a lot of buying pressure there. And then at the resistance level, most of them will be looking at taking sell trades, inducing sell pressure. It is vital to analyze these levels as a trader to identify entries and exit points. While we are still on the topic of time frames and their impact, this is a tendency of turning a lot of traders' lives into a non-stop and nightmare. Looking at the lower time frames, you will realize that they only indicate short-term trends, and the larger time frames, they are more reliable in terms of indicating long-term trades. Understanding these dynamics will help you as a trader to always see the reality of the trend across different periods. In simple terms, multiple time frame analysis helps filter short-term trend trades, which will filter out the noise, which will also make you take less trades. Have you ever heard of the saying, less is more? In trading, that's what usually works. What I usually do on my side, I will use the 4 hour for a trend or the daily. Then I'll go to the 1 hour to validate my pullbacks, volume pullbacks, to be specific. And I use the 15-minute or the 1 minute for entry into the trend with predefined risk on each and every trade. Now I think we can move on to market sentiment. Now let's talk market sentiment analysis, or COT report data, because they go hand in hand. So what are we talking about when you're talking about the COT report? This is the commitment of traders report data. If you had to combine the COT report data, and you do market sentiment analysis using it, you will be able to gauge your trend. Market sentiment analysis gauges market participants' emotions and attitudes towards an asset or a commodity. This is a tendency of influencing buying and selling decisions for traders in the retail space. Market sentiment analysis integrates the commitment of traders report data by measuring traders' position, whether they may be morely bullish or bearish, and behavior as well. Traders' behavior as well is also gauged here. So what they'll do is you'll analyze to say, which orders do we have the most? Do we have a lot of long positions or short positions? This can help you in identifying potential market reversals or trading in alignment with a trend. How many times have you heard about the COT report? Or actually, do you actually understand the information that is populated there? Or the other question is, does it have any value in what we do? Well, let's dive in. First, we're going to start by explaining what the COT report is. So, the COT report stands for the Commitment of Traders Report, which is a report that provides insight on the positions of the market participants, like your commercials and your non-commercials. See, this right here is the source to the dish of trading these financial markets. By being able to interpret long, versus short positions. As a trader, you can gauge whether the trend is bullish or bearish based on the market sentiment. If you can monitor the changes in the reports, this will also help you, because once you monitor the changes, when these guys go from long to short or from short to long, you'll be able to identify the reversal and the beginning of a new trend. So eventually it will help in enhancing decision making and your risk management. Now, the COT report has three groups, which is the commercials. They fall under what we call hedges, meaning they're in the market to not actually make money, but to hedge their risk. And then you've got the non-commercials. Those are what we call speculators. They are in the markets to actually make money. So you want to be in alignment with what? With the non-commercials instead of the retail space. The third group is the retail, which is like the people that actually lose the most out of everybody else. So the commercials, they'll hedge their risk. Non-commercials will make money from the charts. The retail space, they'll sponsor both commercials and the non-commercials. So in this case, I would prefer to be trading in alignment with the commercials and the non-commercials. For instance, at the current moment, we just took a sell on silver. Why did we take a sell? Because we realized that 2 weeks ago, they had a lot of long positions. And they remember that these guys have to report their positions, so they can't go higher than what they had at the time. So we looked for short entries, and we took the short. We're still in it as we speak. Now let's put everything all together. Putting the final nail to the coffin on these markets by actually explaining the interconnecting aspect of these three market forces. If you are to actually understand how each of them works, you will have a very, very strategic approach to these markets, which will be a different type of trading compared to what you were doing before or what you see on social media. Now, you should need to remember that liquidity influences price action by providing the necessary volume for price movement, while price action shapes traders' perception on the issue of trends. And the market sentiment can drive liquidity due to market participants' emotional cues. So when everybody's panicking, they have a tendency of doing what? Looking at what liquidity is doing. Let's move on to the strategy, how you can develop a winning strategy. In your trading strategy, it must identify entry rules and exit rules. You must also be able to define the risk. And all these entries and exit rules must remain the same. And you have to back test it for a little while, then forward test it. And in everything that you'll be doing, there's one other important aspect that you need to look for, which is psychology, which is the biggest part of everything else in trading. I hope you enjoyed the lesson. Thank you very much for attending. If you have any cues, you can actually hit us up, or any topics that you might want us to discuss. And always remember to like and follow so that you'd be able to view all of our content. And there's still more content that we'll be posting with vital information. So I suggest that you follow. Click like and follow. So, quick disclaimer. This is not financial advice. We are not advising you to trade. We will not be held liable or responsible for your bad decisions in the market or for you losing money in the market. This is not financial advice.